Hi friends, we are recording this video to discuss the practical questions which are part of your chapter 3, which is on security analysis. I haven't discussed this as part of the regular class because the questions are slightly unique and I may not be able to add much value in these questions, but still let's discuss them. There are three concepts which we are going to discuss in three questions. One is exponential moving average, which can help you in understanding whether the market is in a bullish trend or in a bearish phase. Bullish is the market going to increase over the medium term, and the bearish phase is if the market is going to come down over the medium term. The second part is on testing market efficiency, where we have two tests. One is on run test, we will test it, and the second concept we are going to do is on the basis of autocorrelation test. I'm going to discuss these two as we proceed. First, let's discuss on something called as exponential moving average. If you look at moving average as a concept, can help us in understanding whether market is likely to go up or come down. So exponential moving average is just another approach, or is one of the approaches in the moving average, which can help us in understanding whether the market is in bullish trend or bearish trend. In the theory part, we were saying that how can you identify buy and sell signal using moving average analysis. A similar concept is on exponential moving average. For exponential moving average, we need an item called as EMA adjustment or the exponent. So the EMA adjustment is calculated as value of exponent which would be given in the question, and as a value which is calculated by comparing the current value of the index as compared to the exponential moving average. So first they would give you values for multiple period. You can take the Sensex data for the last 30 days and calculate something called as EMA adjustment. For that purpose, you need value of exponent, which is given in the question, and value as per step 1. What is the value as per step 1 is the difference between the current index value and the previous day EMA. The EMA adjustment can be plus or minus. If it's minus, you add it to the, if you'll subtract it, and if it's plus, you will add it. Let's look at in the question. Closing values of BSE Sensex from 6th to 17th day of the month of January for the year 2009 is given, or whatever year, whereas follows day, date, day, Sensex. So this is the period for which they have given the data. The data is given for 12 days. In that, trading doesn't happen, I think, in 5 days. So 7 days period data is available. Using this, we will have to calculate the exponential moving average. The starting data is taken as 15,000 and the exponent, the adjustment exponent, is taken as 0.062. Let's capture this information. Date, Sensex, date and Sensex. Our date is 6/7, Sensex is 14,522, 14,925, then it's 10, 15,222, 11, 16,000, 12, 16,400, 13, 17,000, and 17, 18,000. I've just captured the data which is given in the question. So the first thing you need to do is you need to capture this data. So start capturing them. Date and Sensex: 14,522, 14,925, 15,222, 16,000, 16,400, 17,000, and 18,000. EMA value which is given in the question. The 30-day simple average is 15,000. That's the starting value you take. Starting difference is whatever is the Sensex reporting minus the EMA value. Whatever is the Sensex reporting minus the EMA value for that day. EMA adjustment is there is an exponent value given in the question which is 0.062. So this into 0.062 into 0.062 and revised EMA value. Basically this is what they wanted, are the closing EMA. So we started with 15,000. The EMA has become now 14,970 considering this 14,522. Considering the data 14,522, the exponential moving average is now 14,970.36. Then you take that as the starting part. Find out the difference, which is 45.36 negative. Negative 45.36, 14,925 minus this. Multiply with 0.062 and revised EMA value. It has now come down to 14,967. From 15,000 came down to 14,970, further came down to 14,967. The EMA value is showing a declining trend as of now. This is the opening value, difference, adjustment, closing. Difference, adjustment, closing. Difference, adjustment, closing. Difference, adjustment, closing. So you keep doing this, we keep doing this, and that's how we get the closing EMA value. Where the starting EMA value is 15,000 compared with 14,522. It wanted a revision of 29.64 downwards, 14,960 further downward, and thereafter it is continuously going up. The EMA adjustment is continuously showing an upward trend. The EMA adjustment is continuously showing an upward trend. This basically indicates that the market is in bullish trend. The market is in bullish trend. Keep writing this. We started with date and Sensex. The EMA value is given in the question, which is 15,000. Difference is column 2 minus column 3. EMA adjustment is 0.062 into the fourth column, and closing EMA is column 3 plus or minus EMA adjustment. Plus or minus EMA adjustment. Goes on like this. Now the EMA, wait, quickly complete this. Complete this part. EMA is showing continuous improvement. EMA is showing continuous improvement, and hence we can conclude that EMA is showing continuous improvement, and hence we can conclude that market is in bullish phase. Hence market is likely to go up over the near term. Near term is maybe the next few weeks or month. Next few weeks or for a month, the market is likely to keep going up. The market is likely to go up. The market is bullish as the value of the EMA is on increasing trend. The market is likely to remain bullish for short term to medium term. So this is on the exponential moving average computation. The next is on test of market efficiency. Now listen. Market are broadly classified into two categories. Efficient market and inefficient market. Market are broadly classified into two categories, efficient market and inefficient market. What is inefficient market is if it is possible for someone to predict exactly what is going to happen in future, then it's an inefficient market. For example, TCS 100 goes to 110, becomes 115, then 125, 140, 150. It is just going up. The prices are going up every day. The prices are going up every day. So it will become easier for a person to predict, saying that the next day market will stand at 160. market will stand at 160 or the TCS will stand at 160. When you're able to easily predict what is going to happen in future, it is called as inefficient market. It is inefficient market, and inefficient market is what technical analysis thrives on, because technical analysis basically says there are past trends and these past trends are likely to continue in future. These past trends are likely to continue in future. So if your past information is going to predict what is going to happen in future, that is basically a scenario. That's basically a scenario of inefficient market. In efficient market, we have weak, semi-strong and strong. What is efficient market is basically it is not possible for someone, to predict what is going to happen in the market. There are so many people who want to buy and sell share. There are multiple buyers and sellers, so it is difficult for someone to beat the market on a continuous basis. All available is fully reflected. No investor can consistently outperform the market. I can outperform the market if I know what is exactly going to happen. When is it going to go up? When is it going to fall? If you can easily predict it, you will buy it when it is likely to go up, you will sell it when it's likely to go down, and you are going to beat the market. But that is an inefficient market. Efficient market is impossible because there are so many people free and instantaneously available. So much competition is there. So because of that scenario, it is impossible for someone to predict exactly what's going to happen. But even in the efficient market, there are three forms of market: weak, semi-strong and strong. Weak market is what would be prevalent many a times. That is, under a weak market, what happened? Price is going to reflect all the information found on the record of past prices and volumes. The prices is reflecting the information which is more of past historical data. The prices is going to reflect the information, the current data, some results are going to be declared. So the current data is not reflected in the market. If the current data is also reflected, it is a semi-strong form of market. And even if the private information is reflected in the market, then it's a strong form of efficiency. If the market is strongly efficient, no concept of insider trading also can happen, because even the privately available information is reflected in the share price. So you cannot get any information and then try to do something which is privately available. Privately available information, you cannot get access to that and then try to gain out of it. When it is semi-strong form of market efficiency, what will happen is it is going to reflect the past. It's also going to reflect the currently available information. But whenever some information is going to come in, if you are able to do prediction of how the results are going to be, if you are able to predict how the company is going to perform, if you are able to do prediction of how budget is going to impact a company, so you can do fundamental analysis. One is technical analysis, which will work if it's an inefficient market. If it's an efficient market, you can do fundamental analysis and then try to do some prediction. That prediction is not based on the price trends of the past. If you are doing on the basis of price trends, it's an inefficient market. Efficient market is basically on some fundamental factors. So if company is likely to give good results, then you go ahead and buy the share, and when they declare good result in a semi-strong form of market, the price will reflect that. The good results have come, the price will reflect that. So fundamental analysis can come into picture. Now there are two ways of treating this, or two ways of testing this. One is your run test, and second is correlation test. In that we have an auto correlation test which came in exam, and there's a serial correlation test which also I'll discuss. So run test and correlation test are the two ways of doing it. Now what run test basically says is, let's take some price data: 100, 120, 115, 135, 140, 125, 150, 175, 200, 180, 190, 160. You are basically trying to find the you would take the past data, some 12 information I have taken, look at the change. This is a positive change, negative change, positive change, positive change, negative, positive, 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 negative, positive, negative. So you are looking at the changes which are happening. You are looking at the changes which are happening. There can be some positive changes in the price. There can be some negative changes in the price. So look at the historical information, see whether there are positive changes or negative changes. You can take any number of periods. You can take 10 periods, 20 periods, 50 periods, 100 periods, your wish. So you look at this historical information. So there's a positive change, there's a negative, positive change, negative change. Negative is price has fallen. Positive, 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 negative, positive, negative. Number of positive changes 1, 2, 3, 4, 5, 6, 7. 7 times there are positive changes. 4 times there are negative changes. 4 times there are negative changes. Now, what this run test is basically trying to say is how many series of changes have happened in the price. How many series of changes have happened in the price. That is from plus going to minus and from minus going to plus. If plus and plus continues, then it is not a change in direction. So the first change, the first run, second run, this and this together is the third run, fourth run, this together is the fifth run, sixth run, seventh run, eighth run. Out of the 11 price changes which have happened, I could see that 8 runs are there. What is run is a continuous positive or a continuous negative or a single positive, single negative. Whenever from positive you move to negative, it's called as a run. Whenever from negative you move to positive, it's called a run. Now what run test basically says is that this number of runs should not be very low, should not be very high. If it's very low, for example, only 2 runs are there in this. That is, you started with plus, it's continuously plus, then it's continuously minus. Then the problem is, I can say that it will be this market is not efficient because the number of runs are only 2. So if you see a positive price increase, please buy the share. It will be continuously positive. It will be continuously positive. Moment it shifts to negative, please sell the share. It will be continuously negative because either it will always be positive or it will be always negative because the number of runs are very few. The number of runs are very few. Whether 2 is very few, 3 is very few, 4 is very few, you will understand. But if the number of runs are very low, then it's a problem. If the number of runs, let's assume, is 10, then also it's a problem because it will be plus minus, plus minus, plus minus, plus minus, plus minus. So what you can say in that scenario is, if market has gone up, next day market is going to fall. If market has gone up, next day market will fall. So what you do is, please sell it. If there is a minus, next day market is going to go up, please buy it. So it should not be, the number of runs should not be low, should not be very high also. Compute the closing index value for all days and mention the sign of price change. Sign is positive if index has moved up. It will be negative if index has come down. Compute the number of positive changes, we call that as N1. Number of negative changes, we call that as N2. And the number of times the sign has changed from positive to negative, which is called as R. Example, positive, negative, negative, positive, 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 negative, positive. This is the first run, second run, third run, fourth run, fifth run. So the number of runs is 5. We started with positive. From positive, it can be starting with negative, starting with positive, whatever it is. Now, what the concept says is the number of runs should not be very low, should not be very high. It should be within some said limit. It should be within that said limit. That said limit is what we are going to come down. It should be within an average limit. That is, totally 11 times changes have happened. Now, it should be somewhere between these. If it's outside this, very few. If it's above this, very high. Very high changes is also problem. Very high changes means positive, negative, positive, negative, positive, negative. Very low changes means continuous positive, continuous negative. Both are not acceptable. Both are not acceptable. It will lead to an inefficient market. It will lead to an inefficient market. So we calculate what is the average changes we are looking at. What is the average changes we are looking at? What should be the average number of runs? What should be the average runs which should be there? If they have given, let's assume 20 data points, what should be the average runs in this? How many positive and negative changes should happen? That average run is calculated as, you need to remember the formula, 2n1 n2 by n1 plus n2 plus 1. For example, in my example, it would be 2 into 7 into 4 divided by 7 plus 4 plus 1. 2 into 7 into 4 divided by 7 plus 4 plus 1, which is into 7 into 4 divided by 11 plus 1. So basically if 11 data points are given in which 7 positive and 4 negative changes have happened, ideally 6 runs should be there. Ideally 6 runs should be there. If there are more than 6 runs, ideally 6. If there are less than 6 runs or more than 6 runs, it's a problem. But we don't go by exactly 6. We don't go by exactly the number 6. We don't go by exactly the number 6. We look at a range. That range is depending on the standard deviation. That range is dependent on the standard deviation. Standard deviation is 2n1 n2. Again, you will have to remember the formula, into 2n1 n2 minus n1 n2 divided by n1 plus n2 square into n1 plus n2 minus 1. You may see this day before exam. So the upper limit is mu plus standard deviation. The lower limit is mu minus standard deviation for the number of run, and there's some multiplier on this. There's some multiplier. I'll touch upon that multiplier in some time. That's something called as t value. If your final value is between this limit, mark it is efficient. Mark it is efficient. It's weak form of efficiency, because normally markets are weak form of efficient. So if it's within this limit, mark it is weak form of efficient. If it's outside the limit, then there's a problem. Let's look at this in a question. Let's capture this data. Closing value of Sensex for the month of October 2007 is given below. You are required to test weak form of market efficiency by applying the run test at 5% and 10%. Following values can be used for T. Go through the question. Let's capture this information now. Date, Sensex. We are not bothered about how much is the change. We are just bothered about the sign of the change. We are not really bothered about whether it is going up by 10%, coming down by 10%. We are not bothered about that. Let's capture the information. They've given multiple observations, so we'll have to capture all of that. This can be slightly time consuming as well. So this is the observation. I hope I'm not made an error there. 2800, 2780, 2795, 2830, 2760, 2790, 2880, 2960, 2990, 3200, 3300, 450, 3360, 3290, 3360, 3340, 3290, 3240, 3140 and 3260. These are the observation. Change. First observation, there cannot be any change because that's a starting. That's the starting. Negative change, positive change. 2800 came down, positive change, negative, positive, 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 negative, positive, negative, 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 positive. Okay, so I have mentioned the positive and the negative change. The sign of the change is mentioned here. The sign of the change is mentioned here. Number of negative changes is 8 and number of positive changes are 11. Number of negative changes are 8. Number of positive changes, which is technically N1, is equal to 11. N2 equal to 8. And how many runs are there is, this is the first run, second run, continuous because positive, third run, sign got changed, fourth run, positive, 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 fifth run, sixth run, seventh run, seventh continuous, seventh continued, seventh continued, seventh continued, eighth run. So 8 runs are there. 8 runs are there. Now whether this 8 is an acceptable number or not, is it within that limit, which is it closer to the average plus or minus standard deviation? Is it closer to average plus or minus standard deviation? Average plus or minus standard deviation. For average, we take a formula 2n1 n2 n1 plus n2 plus 1, 2 into 11 into 8, 11 plus 8 and plus 1, 11 plus 8 plus 1, 176 plus divide by 19 plus 1. So the average is 10.26. Average is 10.26. If it's 10.26 exactly, or if it's very close to 10.26, I can say market has weak form of efficiency. Our market is efficient. Market is efficient. If it was 10 runs, I could have directly even told, but I'll have to now get to the, anyway, you will have to do the standard deviation calculation. Basically, 10.26 is the average. You can go slightly this side, slightly this side. The number of runs is 8. Now, what is that limit? Lower limit and upper limit is what we are trying to find. For that, you will have to do the standard deviation. Standard deviation is something you'll have to remember the formula. I can't help it. 2n1 n2 multiplied with 2n1 n2 minus n1 minus n2 divided by n1 plus n2 the whole square into n1 plus n2 minus 1. I normally see it before the video, so I suggest you to please practice this day before exam. 2 into 11 into 8 into again 2 into 11 into 8 minus 11 minus 8 whole divided by 11 plus 8 square and 11 plus 8 minus 1. The standard deviation turns out to be 2.06. So it's a 10.26. Mean value is 10.26. Standard deviation is 2.06, range can be 10.26. There's another effect to be given, I'll come to that. 8.20 minus 2, another 2.06 added, 12.32. So our limit is outside this range, which indirectly would mean the number of runs is very few, but there's some adjustment of t value. You can test your market at 5% significance as well as 10% significance. Like you have z value, probability, we also have t test, and for that you get t value. The t value is done for some degrees of freedom. The t value is dependent on degrees of freedom and the test of significance. The degree of freedom and the test of significance. So lower limit, upper limit, 5% test, 10% test, 5% test and 10% test. The lower limit is 10.26 minus 2.06 into some number. For the time being, I'm just writing into 1. I'll write that number. And this is plus. There's going to be some number. For the time being, I'm just writing 1. Now, for a 5% test, you have to multiply this with t value. What is t value is? You'll have to calculate it for 5% and 10% for N1 plus N2 minus 1 degree of freedom. N1 plus N2 minus 1 degree of freedom. So N1 is 11, 8 minus 1, 18 degree of freedom. For 5% this is the value. For 10% this is the value. For 18 degrees of freedom. So 2.101. 2.101 is the multiplier, and this side 1.734. We have a R value which has been calculated, and the R value is 8. The R value was 8, which is within this limit. If it's within the limit, market is efficient. If it is within the limit, which means if you get a positive, you cannot say next day will it be negative or positive. If it's very few runs, if the runs are very few, it means if positive, it will continue to be positive. Negative means it will continue to be negative. If there are very high number of runs, positive, next will be negative, next will be positive, again negative, positive, negative, positive, negative. That is what will happen. So in this scenario, it's very simple. My computed R lies within this limit. Hence, the market is efficient and it exhibits weak form of efficiency. Weak form of efficiency, semi-strong form of efficiency, strong form of efficiency. Weak form of efficiency, only historical information is reflected in the market prices. Once the results come in, that gets reflected, that's your semi-strong, and even the privately related information is reflected, that is called as strong form of efficiency. So one way of testing your efficient and inefficient market is through run test. The second form, see what is inefficient market is if you can easily predict what is going to happen in the market, that's an inefficient market. So we have done one testing. The next test is through autocorrelation test or serial correlation test. Now in an autocorrelation test or a serial correlation test, what we do is we take the information of, let's assume, 2 months, first month, second month, and then see what is happening every day, what is happening to the price every day. If the same thing is happening in the next month, for example, I'll take the data of 20 trading, let's assume I take the data of 60 days, 60 trading days, okay. We split this into 30 trading days and again another 30 trading days. So you write the 30-day period data this side, another 30-day period other side. The first 30-day trading days is called as X, next 30 trading days is called as Y, and you need to calculate correlation coefficient between them. You need to calculate correlation coefficient between these two data period. If there is good correlation, then market is inefficient. If there is a good correlation, it indirectly mean that you can predict whatever happened in the first 30 days, similar action is going to happen in the next 30 days. In the theory, I think there is an error. Maybe we need to correct this. If the correlation coefficient is between 0 to 1, that's not how we conclude. We calculate the correlation coefficient. If the correlation coefficient is close to 0, now what number? I have read through multiple gone through multiple authors, but I have not arrived at a single number they have not mentioned. If the number is closer to 0, if the number is closer to 0, it means there is no correlation between this period and the next period. Maybe you can put it as 0.2 to minus 0.2, or maybe 0.3 or 0.25, some number. 0.2, let's take 0.25 positive to minus 0.25. It means there is no correlation between the first period and the second period. If the correlation is high, let's assume 0.5, 0.6, 0.7, 0.8 or minus. If the correlation is high positive or high negative, it is possible for you to predict what is going to happen in the third period, third 30 days. First 30 days you know, second 30 days you know, third 30 day you can predict it. If on the first day of the first 30 period price has gone up and there's a high positive correlation, which means the next 30 day also would have been going up. Next 61 to 90 days also price will go up. So what happens is, it will measure day 1, day 31, day 91, or day 1, day 11, day 21, day 1, day 6, day 11. You can take some period and then do this analysis. Moment you do this analysis and you get a very high positive correlation, you get a very high positive correlation, it means whatever has happened from day 1 to 30 more or less got repeated in day 31 to 60. Same thing will get repeated in day 61 to 90, 91 to 120. The direction of the change will get repeated. If it's a high negative correlation, then whatever happened in day 1 to 30, opposite of that has happened in day 31 to 60, opposite of that will happen in day 61 to 90. If there is very low correlation, it means there is no linkage at all. Let's do this now. The calculation is on correlation coefficient, which we know. Mr. X is of the opinion that market has recently shown the weak form of market efficiency. In order to test validity, he has collected the following data relating to the movement of Sensex for the last 20 days. We'll split this 20-day data into 10 days and 10 days. You are required to test the weak form of market efficiency using autocorrelation test, taking time lag of 10 days. So the gap is 10 days. That is first 10 days and 11 to 20. Is there any linkage? If there is linkage, market is inefficient. If there is a linkage, market is inefficient. Day will capture the first 10 days. We are required to calculate correlation coefficient, whatever we learnt in portfolio chapter. We are required to calculate that. Values are given in the question: 33,453.99, 0.83. Just hope I don't make an error in noting down the values. Closing values, I'm not bothered about the high, low and all. So I've captured the 20-day period values here. 3343.99, 33434.83, 93, 83.41, 70.93, 40.75, 30.98, 35.08, 01.97, 259.03, 251.53, 85.89, 329.28, 284.17, 298, 325, 329, 319, 302 and 319.61. Now, in order to do a correlation test, we need the change, because we are seeing whether the change, is there any correlation between the change which is happening here and the change which is happening there. So change for a 9-day period only I can calculate the change, and similarly the change here. We have computed the change, and is there any linkage between the first 10-day period change and the next 10-day period change? Is there any linkage? Basically the nine periods. We can do a correlation coefficient for 9 periods. So probability, which is technically 1 by 9, probability 1 by 9, 9 observations are there. I assume equal probability and proceed ahead. 9 observations, equal probability. To avoid rounding off caps, I have taken 4 decimal for probability. Value of x, value, or okay, let's keep it like this. Value product deviation PD square. I call this as the first 10-day period change is called as x, next 10-day period is y. We used to call it a security x, security y. So x, return product deviation PD square, y, return product deviation PD square, and probability into deviation into deviation, probability into deviation into deviation, probability into deviation into deviation, the values are given here. This is the value of x, value of y, and we are required to find a correlation coefficient between this. We are required to find a correlation coefficient. Is there any linkage that when market is going up, is it going up here? When market is going down, is it going down here? Do we see any kind of a linkage here? If we see a linkage being there, then it is technically an inefficient market. Product deviation x minus x bar. We have done all of this in the portfolio chapter. Probability into deviation into deviation, probability into deviation into deviation, into deviation into deviation, again deviation. I just hope there is no calculation errors. Probability into deviation into deviation. And finally probability into deviation of x into deviation of y. Deviation of x and deviation of y. Just let me check, I think. No. Probability into deviation of x, deviation of y. I just hope there are no calculation errors. Let me just quickly check these numbers. 19 product, sum of the product, deviation is okay. Probability into deviation, again values product, deviation, probability into deviation, okay, should be right. Standard deviation is square root of this, and correlation coefficient, I don't want to spend much time on explaining correlation coefficient. Correlation coefficient is this divided by standard deviation of 1 and standard deviation of 2. It's 0.4054. If it was between minus 0.25 to 0.25, there's no linkage at all. There seems to be some positive linkage. There seems to be some positive correlation between what has happened in the first 10 days and what has happened in the 11th to 20th day. So similar thing can happen on day 21 to 30. There is not a very high linkage, but still there is a good amount of linkage, 0.405. So whatever is happening on day 21 to day 11 to 20, a similar action can happen on day 21 to 30. So this is an inefficient market. This is not an efficient market. Not an efficient market technically means it's not 0.405. So it's not an efficient market. So it's an inefficient market. Hence market does not show weak form of efficiency. The market is not showing that efficiency. It's an inefficient market. Now this was autocorrelation test. Serial correlation test can also be tested in exam, which is nothing but here when you do the change, instead of having the absolute number, you will have the percentages. Brought in. So the percentage changes are factored in here. The percentage changes are factored in a serial correlation test. In a serial correlation test, you will do with the percentage change. Broadly, the end result may be the same. Small variation can also happen. You will have to work with percentages. I will remove the rounding of impact now, because rounding off can have a bigger impact in this kind of a problem. The numbers are very insignificant because the percentage change is very low. The numbers are very insignificant, can't help it. Because the question has given very low percentage change. The correlation coefficient turns out to be 0.4044. The only difference is, instead of doing the absolute change, you will have to do the percentage change. Percentages are very low. That's the problem. The problem is 19 on a base of 33,453 will not be even 0.1%. It is in fact 0.05%. So because of that, we are not seeing big impact. We are not able to see some big values, and that's why I'm not able to show this calculation properly. So there are two forms of market. There's an efficient market and inefficient market. Efficient market can be weak, strong, or semi-strong. In order to test whether it's efficient or inefficient, we have an autocorrelation test or a serial correlation test, and we also have a run test. Run test is basically does not worry about the amount of change, it just is bothered about the sign of the change, whether it's positive or negative. We calculate the number of runs which have happened and then check whether the runs are within that applicable range. Is it within that required range? If it's within that required range, then the market does not, then the market is showing, market is an efficient market. And if it is outside the range, it is inefficient. If correlation is between maybe minus 0.25 to plus 0.25, market is efficient, weak form of efficient. Otherwise, it's an inefficient market. With this, I'll end this part. We have covered all the three questions. If there are doubts, you can message me on this area.